Hi, good day ladies and gentlemen. I am Dato Israel T. Comandan, and in this video presentation, we are about to discuss the Auditing and Internal Control Part 3. Let's continue the learning. Now, what is our scope for Part 3? We have two topics. We have the audit risk and the IT audit. Now, for the audit risk, we have subtopics, and these are the audit risk components, the inherent risk, detection risk, audit risk model, and the relationship between test of controls and substantive tests. On the other hand, we have the IT audit, and its subtopic is the structure of an IT audit. Now we are about to unlock a new learning. First in line, we have the audit risk. Let's go! Now let's dive in first to the definition of audit risk. Audit risk, this is the probability that the auditor will render unqualified opinion on financial statements that are in fact materially misstated. Material misstatements may be caused by errors or irregularities or both. Now, these errors are unintentional mistakes. Irregularities are intentional misinterpretation associated with the commission of a fraud such as the misappropriation of physical assets or the deception of financial statement users. Now, let's talk about the audit risk components. Now, we know that the auditor's objective is to achieve a level of audit risk that is acceptable to the auditor. Now, acceptable audit risk is estimated based on the ex-ante value of the components of the audit risk model. And these are the inherent risk, the control risk, and the detection risk. For number one, we have the inherent risk. Now, this inherent risk is associated with the unique characteristics of the business or industry of the client. Firms in declining industries have greater inherent risk than firms in stable or thriving industries. Likewise, industries that have a heavy volume of cash transactions have a higher level of inherent risk than those that do not. Also, placing a value on inventory when the inventory value is, difficult to assess due to its nature is associated with higher inherent risk than in situations where inventory values are more objective. For example, the valuation of diamonds is inherently more risky than assessing the value of automobile tires. Now, the auditors cannot reduce the level of inherent risk. Even in a system protected by excellent controls, financial data, and consequently, financial statements can be materially misstated. For number two, we have the control risk. Now, this control risk is the likelihood that the control structure is flawed because controls are either absent or inadequate to prevent or detect errors in the account. Now, to illustrate this control risk, let's consider the following partial customer sales record, which is processed by the sales order system. We have here the quantity, which is 20 units, unit price $40, and the total amount or value $8,000. Now, assuming that the quantity and unit price fields in the record are correctly presented, the extended amount or the total value of $8,000 is in error. An accounting information system or the AIS with adequate control should prevent or detect such error. But if controls are lacking and the value of the total in each records is not validated before processing, then the risk of undetected errors entering the data files increases. Auditors assess the level of control risk by performing tests of internal controls. In the preceding example, the auditor could create test transactions, including some with correct total values, which are processed by the application in a test run. The results of the test will indicate the price extension errors are not detected and are being incorrectly posted to the accounts receivable file. Now we are down to detection risk. The risk that auditors are willing to take that errors not detected or prevented by the control structure will also not be detected by the auditor. Auditors set an acceptable level of detection risk or the plant detection risk that influences the level of substantive tests that they perform. Like for example, more substantive testing would be required when the plant detection risk is 10% than when it is 20%. At this point of time, let's dive into the audit risk model. Yes, you heard me right. In auditing, we also have models. Financial auditors use the audit risk components in a model to determine the scope, nature, and timing of substantive tests. The audit risk model is AR is equal to IR times CR times DR. AR, this is the audit risk. IR, this is the inherent risk. CR for control risk, and DR for detection risk. Now, to make things crystal, let's have an example in connection with audit risk model. Assume that the acceptable audit risk is assessed at a value of 5% consistent with the 95% confidence interval associated with statistics. By illustration, assume that the IR is assessed at 40% and the CR is assessed at 60%. What would be the level of plant detection risk or DR needed to achieve the acceptable audit risk or AR of 5%? Now let's try to solve this using the audit risk model. Now here is the solution. First things first, let's do the substitution. That would be 5% is equal to 40% times 60% times the DR or detection risk. And then let's do the transposition. It would become DR is equal to 0.05 divided by 0.24. And we would get the final answer of DR is equal to 0.20 or 20%. Now, let's reduce the control risk or our CR value to 40% and recalculate DR, meaning from 60%, we would make it on the second example 40%. Now again, let's do the substitution. 5% is equal to 40% times 40% times DR, and then transposition, and we will get the final amount of DR or detection risk is equal to 0.31 or 31%. Notice that to achieve an acceptable level of audit risk in the first example here, the auditor must set plant detection risk lower than in the second example. This is because the internal structure in the first example is more risky than it is in the second example. To achieve the planned detection of 20% in the first example, the auditor will need to perform more substantive tests than in the second example, where the risk is lower. And now this relationship is explained below. Yes, in this slide, we will explain the relationship between tests of controls and substantive tests. How are they connected? Now, tests of controls and substantive tests are auditing techniques used for reducing audit risk to an acceptable level. The stronger the internal control structure as determined through tests of controls, the lower the control risk and the less substantive testing the auditor must do. You know, this relationship is true because the likelihood of errors in the accounting records is reduced when controls are strong. In other words, when controls are in place and effective, the auditor may limit substantive testing. In contrast, the weaker the internal control structure, the greater the control risk, and the more substantive testing the auditor must perform to reduce total audit risk. Evidence of weak controls forces the auditor to extend substantive testing to search for misstatements. Now, in summary, the more reliable the internal controls, the lower the CR probability. That leads to a lower detection risk or DR. which lead to fewer substantive tests being required. Because, substantive tests are labor intensive and time consuming. They drive up audit costs and exacerbate the disruptive effects of an audit. Thus, for that reason, management's best interests are served by having a strong internal control structure. Now, let's dive into the next topic, the IT audit. Come on! At this juncture, let's have an overview of the IT audit. Now, the public expression of the auditor's opinion is the culmination of a systematic financial audit process that involves three conceptual phases, and those are the audit planning, the test of controls, and the substantive testing. Now, later on, we will be discussing these three conceptual phases. Moreover, an IT audit focuses on the computer-based aspects of an organization's information system, and modern systems employ significant levels of technology. Like, for example, transaction processing is automated and performed in large part by computer programs. Similarly, source documents, journals, and ledgers that traditionally were paper-based are now digitalized and stored in relational databases. As we will see later, the controls over this process and databases become central issues in the financial audit process. Now, in order for us to visualize the structure of an IT audit, I have prepared here an illustration about its structure. We have step 1, the audit planning phase, step 2, the tests of control phase, and step 3, the substantive testing phase. Now, let's dive in deeper about the structure of an IT audit. Starting off with the audit planning. Now, the first step in the IT audit is audit planning. Before the auditor can determine the nature and extent of tests to perform, he or she must gain a thorough understanding of the client's business. A major part of this phase of the audit is the analysis of audit risk. The auditor's objective is to obtain sufficient or enough information about the firm to plan the other phases of the audit. The risk analysis incorporates an overview of the organization internal controls. During the review of controls, the auditor attempts to, understand the organization's policies, practices, as well as its structures. In this phase of the audit, the auditor also identifies the financially significant or essential, applications and attempts to understand the controls over the primary transactions that are processed by this application. The techniques for gathering evidence at this phase include the conducting questionnaires, interviewing management, the reviewing system documentation, and observing activities. During this process, the IT auditor must identify the principal exposures and the control that attempt to reduce these exposures. Having done so, the auditor proceeds to the next phase where he or she tests the controls for compliance with pre-established standards. For the second step, we have the tests of controls. Now, the objective of the test of controls phase is to determine whether adequate internal controls are in place and, functioning properly. To accomplish this, the auditor performs various tests of controls. The evidence gathering techniques used in this phase may include both manual techniques and specialized computer audit techniques. At the conclusion of the test of controls phase, the auditor must assess the quality of the internal controls by assigning a level for control risk. As we have discussed earlier, the degree of the reliance that the auditor can, ascribe to internal controls will affect the nature and extent of substantive testing that needs to be performed. For the last one, we have the substantive testing. Now, this third phase of the audit process focuses on financial data. This phase involves a detailed investigation of, specific account balances and transactions through what are called substantive tests. Like for example, a customer confirmation is a substantive test sometimes used to verify account balances. The auditor selects a sample of accounts receivable balances and traces this back to their sources, the customers, to determine if the amount stated is in fact owned by a bona fide customer. By doing so, the auditor can verify the accuracy of each account in the sample. Based on such sample findings, the auditor is able to draw conclusions about the fair value of the entire account's receivable asset. Some substantive tests are physical, labor-intensive activities such as counting cash, counting inventories in the warehouse, and verifying the existence of stock certificates in a safe. Now, in an IT environment, the data needed to perform substantive tests, such as account balances and names and addresses of individual customers, are contained in the data files that often must be extracted using the computer-assisted audit tools and techniques, or the CAATTS software. Now, for better understanding, I have here an illustration of the steps involved in these three phases: the audit planning phase, test of controls phase, and substantive testing phase. Starting off with the audit planning phase, the steps involved are: number one, review organization's policy, practices, and structure. Number two, review general controls and application controls. Number three, plan tests of controls and substantive testing procedures. Now, for the test controls phase, this includes the fourth step, which is to perform test of controls. Fifth one would be to evaluate test results. And sixth one would be to determine degree of reliance on controls. Now, for the last phase, the substantive testing phase, this includes the seventh step, which is to perform substantive tests. Eighth step, which is to evaluate the results and issue auditor's report. And the last step would be the audit report. Now, again, these are the steps involved on the three phases of an IT audit. That's all for the part 3 of our report. Once again, I am Kamandan Dato Israel. Thank you, and we shall proceed to the next part. Bye!